Hello, it's Tuesday, the 5th of February, 2008. This is Brian Shannon from AlphaTrends.net, and the market's closed, and this is why you don't trust rallies in a bear market. We've been seeing some signs of weakness in the market overall the last couple of days as it closed below that daily VWAP, as I pointed out yesterday, and for the VWAP of the last 2 days. And there was reason to think that this area was going to provide some resistance in here, as we'd been looking at first this Fibonacci level off of the December high right here. So it was in right around near that 61.8% retracement level, as well as the reason that we were expecting maybe that this area was going to provide weakness was because of this low right here at the about 141 level, and we've got that declining 50-day moving average. So when we look at the weekly time frame, you can see here that support broken tends to act as resistance. It doesn't always occur in the same exact spot, but close enough. In particular, when we saw that this volume was really starting to trail off here the last couple days. So now when we look at this market, we had been encouraged that the 5-day moving average was still advancing, and yesterday, it continued to hold above that level. But as I was saying, there were a lot of reasons to be cautious. First of all, the long-term trend was down yesterday. Intermediate-term trend was higher, and the short-term trend was down. Well, now we've got all three trends lower. We've got the long-term, intermediate, and short-term trend lower. So no more mixed messages. We're clearly back to sellers being in control of this market. You can see here on today's daily VWAP that it was pretty much sellers had control almost the full session. We had a little bit of back and forth as it's attempted to stabilize there after the gap lower opening. However, sellers were persistent, and it continued lower throughout the day. So when we look now at a let's take a look at the 30-minute time frame. What we'll do here again is take a look at the VWAP since the Federal Reserve began cutting interest rates this year. So we had the 75 basis point cut on this day right here, and I'm going to drag my pen directly across, and you see the average price found support right in here, and then once again at that level. Now the market is below the level since they've cut rates 1.25 percentage points. So there are a lot of reasons still to be very concerned about this market. Potential for support is down here near 132, and then we would be looking at a retest of the lows. I'd still like to see a retest of the lows. I think I've said that a couple times in the last couple of weeks, that would be the best thing, is for a retest of the lows, as it would then maybe get that shakeout that really scares enough people to think that it could turn around. However, again, we're in a down market. It's looking for that the bottom is going to be as elusive as trying to find the top. The top was a process. It took months for the market to break down, but there were technical signs that gave us a clear indication that things were getting worse. Now we're clearly in the middle of this bear market, and looking for the lows is really very premature. We've got the 10-day moving average below the 20 below the 50, then the 50 below the 200. They're all declining. We've got just a bearish environment, and it's going to take time to heal it. So get used to it. The semiconductors, we've been looking for a move above that 365 level as a potential for a short squeeze rally to develop. We got a big short squeeze rally off that level on Friday. It rallied right up to these lows from the last couple of years near 380. And then when we take a look again at this shorter term, let's take a look at that 30-minute again. You can see here that I thought that maybe it could begin moving higher again today if it got above 374. But these rallies in a downtrend do tend to fail more often than not, as the bottom is a process, not an event. It doesn't occur, in just a couple weeks either. It's going to take months of time. We're going to need to see this 50-day moving average flatten out as a minimum. You want to keep an eye on the direction of the 50-day moving average, very similar to the way we keep an eye on the 5-day moving average. And, as we're looking for this market to rally on the intermediate term, we're looking for the 5-day moving average to flatten out. Same thing happens with the 50-day moving average, but obviously it just takes a lot longer. So the market remains in serious trouble, and there's really no sense in looking for for bottoms, but what we do look for is areas where there's the potential for support to be found, so that we can reconsider short positions and maybe look for those long side bounces. But again, all those long side trades are very high risk when the overall trend is lower, and that's something I've been saying consistently for the last several months here. 73, again, that's the clear level where this market is going to need to get back above before we really have any faith in any ability for the buyers to maintain their control of the market in here. And today we see that that 73 level has been acting as resistance. We've also got that declining 50-day moving average in here, and it was also some Fibonacci resistance as well. So when we have a confluence of those technical indicators coming together, you have to pay particular attention. And although it didn't look like the sellers were taking control yet, yesterday I did point out here that perhaps this was the first lower high, and that breaking below the 72 level will give us reason to become very defensive and in fact look for short sales. So the market remains in serious trouble. You can see that it's trying to find support along a trend line. Trend lines aren't really good levels of support. So again, if I'm looking for support, it's only as a place where maybe you just become less aggressive on the downside trades. If we look at the VWAP since the Federal Reserve cut rates for the Russell 2000, this market does hold on better once again. So it does show relative strength since the Federal Reserve cut, in the fact that it does remain above. The average price is higher, so there's generally better feeling amongst the long holders in this market because they're not quite underwater yet. They're getting very close though, and here's that trend line I just pointed out. We could take a look at the 1 minute time frame in here. You can see just a classic downtrend in here, just this classic lower highs and lower lows. No reason to be involved in the long side in here. So just continue to be very, very cautious, and in fact probably should be trading those inverse ETFs. Again, for the Russell 2000, it's the TWM. This is the double inverse ETF for the Russell 2000, and the chart's going to look just the opposite. Look at how we saw a little bit of resistance. Well, that's not what I meant to do. What's going on there? Let's take a look at that again. We saw a little bit of resistance, we're near that $80 level, and we had these higher lows in here. The market broke out. That level became, the resistance became support. You call that an ascending triangle. And then it became support again and continued higher. Well, it's going to look just the opposite here. We had this support. We had these lower highs. So these are just the inverse funds. A lot of people email me sometimes and aren't quite sure what I'm talking about, but that's what they are. Search inverse ETF or ProShares. I wrote an article about them once on my blog. So if you look at the, let's see, the NASDAQ 100 next, this market was down $1.28 or 2.8%. So again, it was down more than the S&P 500. It was down more than the Russell 2000. So it continues to be the area where we're seeing the most weakness. And we'd seen resistance at 46. Now there's the potential for support near 43. But again, those potential support levels usually just serve to slow down a declining market. So below 40, and in fact that's more near 43.5, below 43.5, then things could accelerate pretty quickly to the downside as we may see a test of these lows. The VWAP since the Fed cut in here, you can see that we're clearly below it. The average price since the Fed cut rates was 44.33. And here we are at 43.67. Let's take a look at the VWAP for the year, because that's kind of interesting too, because the buyers had been in control for the year. Now look at that; it's right there at about 46 for the Qs, for the spiders, right here at about 137. So these key levels, are where the volume has traded on average as well. And for the Russell 2000. For this year, the average price that we've seen it trade hands at is right about where we are. We're actually a little bit higher, about $70.30. So, you know, we're in a downtrend, and rallies will continue to fail.